How do you think the economy may affect the closed-end fund market in 2017? What factors are you watching most closely?
Well, the largest two factors that we think about with our closed-end fund investing and with respect to the economy tend to revolve around how far away are we from a recession? Is a recession a reasonable possibility? Because that's going to overall affect the credit and credit spreads. And there's a lot of funds with varying degrees of credit embedded in them, which will affect the price performance. So we see a fairly slight growth in 2017, but we think the risk of recession is very, very low. And then the other issue is interest rates, and I think steadily rising interest rates is something that we are comfortable with in terms of how they would affect the closed-end funds. A shock would be a more rapid move by the Fed, let's say more than 2 interest rate hikes in 2017 would cause some dislocation in closed-end funds.
I think interest rates are the biggest thing to watch next year for economic impact on closed-end funds, particularly for bond funds. And I also think that the pace of the recovery in the economy will affect equity closed-end funds most specifically.
The election changes kind of changed everything, the election outcome. And since the election, we've seen a lot of interest in infrastructure, people concerned about inflation, the yield curve, rates going up, long-term rates going up. How that's going to affect the closed-end fund marketplace in 2017? Likely the continuation, maybe a stalling out, but at some point, expectations of inflation should be built in. I think a lot of what we saw here in November, early December of 2016 is going to persist into 2017.